We're in the first third of crypto fall. Crypto fall started in May-ish, and so I guess we're in the first quarter of crypto fall. And the last half of crypto fall is going to be unbelievable. One Bitcoin is one Bitcoin. Bitcoin stays Bitcoin. The currency we denominate it in, dollars, yen, euros, renminbi, what goes down. That is functionally what we're talking about, right? If all fiat currencies stopped printing money, Bitcoin would not go up, right? Other than daily supply and demand, and the price would move a little bit for buyers and sellers. The reason a store of value, gold and Bitcoin, rise, and housing to an extent, and some other things, is not that they go up. It's not that they get better. It's that the money gets worse.
Mark Yusko begins by framing the current market phase as the first third of what he terms crypto fall. According to Yusko, this period began around May and is now entering its first quarter. The significance of this phase cannot be overstated, as it marks a crucial turning point in the broader market cycle. Yusko predicts that the latter half of crypto fall will be nothing short of spectacular, setting the stage for what he believes will be the greatest Thanksgiving Bitcoin enthusiasts have ever experienced. For the past few years, Bitcoiners have been sidelined during holiday gatherings, often ridiculed for their beliefs in digital gold. However, Yusko envisions a reversal of fortunes, with Bitcoin advocates being welcomed back with open arms as the asset's value surges. Yusko is confident that Bitcoin will reach six figures by the time crypto winter begins, which he anticipates will be around March or April of the following year. While he doesn't pinpoint an exact figure, he suggests that Bitcoin could easily surpass $100,000, potentially reaching heights of $121,000, $315,000, or even higher, depending on market dynamics. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We're in the first third of crypto fall. Crypto fall started in May-ish, and so I guess we're in the first quarter of crypto fall. And the last half of crypto fall is going to be unbelievable. I mean, it's just going to, and look, I've said this before, this is going to be the greatest Thanksgiving Bitcoiners have ever experienced, because we're finally invited back, right? We haven't been invited. We've been persona non grata for the last couple of years. And this time we're going to be welcomed in with open arms, and the run is going to have started. And, every day after Thanksgiving for the last few years, I've gone on this show on CNBC with Brian, and it's the early morning show. It's 5:30 Eastern time, and I'm in Tulsa, so it's 4:30, and I'm on there propping my eyes open with toothpicks because I hate morning. And, I talk with him about Bitcoin, and inevitably this is going to be an amazing conversation, because I think that's going to be the beginning. And from November to, call it March, April, when we start to peak toward crypto winter, I stand by my call that we'll easily see six figures. And how high into six figures, like 120, 130, 150, I don't really know. Just depends on how much leverage comes back in the system. Trading isn't bad in and of itself. I mean, there is demand for iBit shares. There is. But the problem is the price of Bitcoin is also impacted by the futures market. And this is one of the things you can see it almost just about every day. You get these big drops, like $1,000, $1,500. It's like, whoa, what's going on? Who's selling? No one's selling. No one who owns Bitcoin on a ledger or a treasury is selling. No one. No one who owns the ETF is selling. It's these futures selling, and that changes the price because there's a little quirk on how ETFs work. ETFs don't trade all day long, right? They trade in a very small window at the end of the day. So it's logical. If you got a big order, you got a big order, you're BlackRock, and you have to fill that order with Bitcoin. You don't want the price high. You want the price low. So you actually, somewhere else in your book, might, not accusing anybody of anything, you might go out and sell the shit out of Bitcoin to push the price down so you can buy it for cheaper. That tends to happen on Wall Street all the time in all assets. So, if you really want to buy a lot of something, you don't tell everybody you love it. You don't go out and buy it. You actually go short a little bit. One Bitcoin is one Bitcoin. Bitcoin stays Bitcoin. The currency we denominate it in, dollars, yen, euros, renminbi, what goes down. That is functionally what we're talking about, right? If all fiat currencies stopped printing money, Bitcoin would not go up, right? Other than daily supply and demand, and the price would move a little bit for buyers and sellers. The reason a store of value, gold and Bitcoin, rise, and housing to an extent, and some other things, is not that they go up. It's not that they get better. It's that the money gets worse. I do think this is going to be a really important time, and it's mostly just supply and demand, in that the ability to spoof the price in the futures market does go down over time. If you look at gold, when the gold ETF came out, it took 9 months before gold got back to the price it was before the ETF was launched. And everyone's like, whoa, what happened? Think about it. The reason the gold ETF was created was because JP Morgan was actually short 2 times the world's gold. Just let that sink in. And you're like, how do you know that? I'm like, because a friend of mine who runs a giant hedge fund actually went through the 400 pages, not 400 boxes, 400 boxes of documents that were posted on the internet after the global financial crisis when they got bailed out. So long story short, they were short all this gold. And so they delayed the release of GLD for 3 years. And then finally said, okay, now we're short. So now you can have the patsy longs come in and take the other side of our shorts. And so they spoofed that price for 9 months before.
Let the floodgates open.
No, because what happens is, remember, the futures price is higher than the spot price because we're optimistic humans. And when that spread is really high, there's a huge windfall to short the future and buy the spot.
Free money.
But as more people do it, the spread closes. And when the spread hits the cost of financing, game over. I mean, not game over like bad stuff happens. It's not.
No, then they all just get long. Then they all just take the spot long positions and ride it to Valhalla.
Exactly.
Raoul Pal explains that the Federal Reserve's policies have far-reaching implications beyond the U.S. borders. As the Fed tightens, the dollar strengthens, putting pressure on countries with dollar-denominated debt and those that rely heavily on exports, such as China. This dynamic creates a feedback loop where the Fed's actions slow down the global economy, which in turn helps to dampen inflationary pressures in the U.S.
Every time the Fed tightened, the dollar rallied a lot. And then what happened was that the tightness of monetary policy got transferred around the world, and the weakest link would blow up. I think what just happened with China is the Fed blew up China, right? It's not such a bad thing that we can control what happens over there with our interest rates. But the reality is the dollar went up a lot against the yen, a lot. And it didn't go up quite as much against the dollar. The dollar didn't go up quite as much against the RMB because there's a peg, quasi-dirty peg going on there. So Japan and the rest of Asia just devalued massively against China, right? So that hurt China. Also, dollar's becoming more expensive, pressured, the leverage player out there, and that's China. The real estate sector is still ridiculously levered. So it's pretty much the same thing that we've always seen, Raoul. I mean, it was, all of these crises over the years. And it's largely because China does not have a floating currency. They're not big boys. They try to be big boys. They say they're big boys on the global stage, but they don't even manage their own currency. It's kind of a joke a little bit. The peg is left over from before when they were communists, and they never really adjusted. So they don't have a free-floating currency. It's not quite like the Arabs, who are completely pegged to the dollar, Saudi and all the Middle Eastern currencies. There's a complete peg there. But it's kind of funny. China's a $20 trillion economy, and it doesn't have, can't manage its own currency. So as a result, they don't have their own monetary policy. And so, I think rates there probably are going back to zero, Raoul, don't you think? I was looking at 2 or something, right?
Yeah, I was looking at the 10-year bond rate, which is actually a big influence on the crypto price, bizarrely. And 10-year yields in China are at like 2.1% or something, and they just look like they're going to approximately zero. And we know this because this is the Japan playbook, right? When you've got an aging population aging as fast as that, you've actually lost control of your growth engine. So the natural rate of interest rates has to be much lower. And it shows you've got a debt crisis.
Yeah, and I think that took the edge off of the inflation bump here because China has been, deflating, or let's just say in trouble for over a year. So I think that helped also sort of works in a feedback loop, right? The Fed, they tightened, it forced a slowdown there, and then that slowdown there helped take the edge off of the inflation.
And what we're seeing now is the flip side of everything that Dan's saying. So the flip side is people start cutting rates, you start easing conditions, bond yields start to fall everywhere, the dollar starts to fall. The
dollar is in a bear market now.
That's right.
And it just kicked off a few weeks ago.
That's right. Now it means it eases financial conditions for everybody. That drives the business cycle. As the business cycle picks up, people have more earnings, they invest stuff, markets go up, and that pattern has always gone on, the business cycle. They all have to finance the same deficits. There's no way around it. There's no way you can use austerity to get out of this anymore. It's way too big. So no, we've seen it. Every political party since 2008 has done basically the same thing. So I don't think it makes a difference. Dan, do you think it makes much of a difference?
Well, it can shift capital flow. The bulk of capital, global capital, pretty much stays, moving based on certain cues that we talked about, whether it's data or policy. But look, it's very clear if Kamala wins, she's less capitalist, pro-markets than Trump. Look, Trump, for whatever you want to say, the only president in my lifetime that actually knew where the S&P closed every day at 4 p.m. I'm a free markets guy. Everyone has their priorities of what they care about in politics. For me, free markets are at the top. And he's not a free markets person. So if you're an investor, maybe you're a little worried more about the U.S. and then maybe you shift capital to Europe or maybe Asia or somewhere else. I don't know. But the cycle, as Raoul is describing it, as I think you're talking about, that's at the moment now it's kicking in, right? There are leads and lags. You can be early by a year seeing it, but now it's really going to kick in. The dollar bear market, watch the dollar. The dollar trades, $7 trillion a day. People forget the global currency markets. It really is sort of a reflection of how easy or tight dollar liquidity is. And so now the dollar will enter into a bear phase. And I think that's going to be positive for all assets here. It'll also take pressure off of the countries that were hurt by the Fed policy hikes.
As other central banks around the world respond by cutting interest rates, bond yields begin to fall, easing financial conditions globally. This process, Pal argues, is now well underway and will drive the next phase of the business cycle. As financial conditions ease, businesses will start to invest and expand, leading to increased earnings and rising asset prices. This cyclical pattern has repeated throughout history, and Pal sees no reason why it won't continue in the current environment. Please like and subscribe my channel.